question. A recording of today's webinar as well as presentation materials will be available at farmcrediteast.com/webinars for access after the webinar. I'll now turn it over to Chris Lawton, Director of Knowledge Exchange here at Farm Credit East, who will be introducing our presenters today.
Great, thank you very much, Kyle. So today we're lucky to have two great presenters. We have Rich Morrison, who's Vice President of Farm Services with NAU Country Crop Insurance. Rich was raised on a corn and soybean farm in East Central Illinois, and he's a graduate of the University of Illinois. He spent 12 years working in the grain business prior to working directly with producers to manage their farm risks beginning in 2000. Rich's role with NAU Country is to provide market information and revenue management advice to producers in a variety of ways, including in-person meetings and tools like the daily opening bell call, the NAU Country Market Report daily email, the monthly Aftermath webinar, and the Kicking Up Dust podcast. He provides a daily market report on radio in Jacksonville, Illinois, and he's a regular contributor to the Red River Farm Network and the American Ag Radio Network. Our other presenter today will be Zach Harding. Zach grew up on a small beef farm in central Pennsylvania and has been involved in the ag industry since he could walk. After graduating from Penn State with a degree in agribusiness management, he immediately began a career in grain merchandising for the Lansing Trade Group. His experience started in Midwest truck markets, then export containers, ethanol, and finally the Northeast feed grain markets, where he's traded for over 10 years. In 2019, the Andersons, Inc., a large Midwest ag services company, acquired Lansing Trade Group and maintained its Auburn, New York office and staff. Zach and his team continually strive to provide top-tier marketing solutions, including hedging, risk management, logistics, and customer service to all producers, regardless of size or commodity mix. So with that, we'll turn it over to Rich and let him begin his presentation.
All right, well, thank you for having me today. Thanks for everyone joining on.
Rich, we can see your screen and we can hear you fine, so you're good.
Okay. Well, thanks for the invite today to get to visit with you about markets and some of the things we're looking at for 2021. We'll kick right into it. Usually my focus with NAU Country really revolves around these three things. And of course, marketing is at the top of my list, but it all begins with crop insurance. And if you're going to be an aggressive forward marketer, an effective forward marketer, you really need to decide first on how you're going to protect those bushels and how you're going to get your bushel guarantee put in place. And once you have that, then you can utilize those bushels to try to lock in price when you have opportunities to lock in profitable levels. And, you know, the last 5 or 6 years, we haven't necessarily had that. This year, the opportunity is here. And so I think that's kind of my buzzword for this year is opportunity. And we'll talk more about that as we move forward. I will also hit on the government program election that's coming up. We do have a decision to make here by the middle of March. I don't think it's as important as it's been in the past, given where prices are at today, but nonetheless, we still have the election to make. So we will talk about that after a bit. So starting with markets, this is a picture of the Goldman Sachs index going back to 2018. And this index isn't just ag markets, it's all commodities. It includes the energy sector, the precious metals markets, some of the soft commodities like cotton, lumber, et cetera. But it's really interesting to look back at 18 and 19 and how flat markets were. Commodities just weren't really going anywhere. And even back into 17 and 16, we just didn't have a lot of movement in the commodity markets. That all changed in early 2020. The COVID outbreak caused big selling across all markets, not just commodities, but stock market as well. We saw the Dow trade down to 18,000 points as people panicked and started bailing out of all of these markets. Eventually, the index went down, made its low in late April. One thing that's interesting, you know, when that happened, you know, you look at crude oil. Crude oil went to negative numbers on that dip. You know, you could have been paid to actually take delivery of barrels of crude oil if you would have executed the trade. Now, it didn't stay there very long. And by May, people started trying to guess what's going to happen when we reopen. And so you saw the oil market bounce back. The lumber market, one of the leaders, you know, with COVID, we saw a lot of new projects take place. We saw lumber go to new highs. So the second quarter of the year and into the third quarter, most of that rally didn't have anything to do with ag. Most of that was the speculation of what was going to happen once things reopened. Ag really kicked in August, and it was a combination of factors. We had some disruptions to supply. We had production issues with a big windstorm going across Iowa, even causing damage as far east as Indiana. Record amount of damage in some of that area. We saw drought affect crops in parts of the country. And then on top of that, we saw China show up and finally start buying, and they bought in a big way. And so the combination of supply problems along with demand, it really brought a lot of new buyers into the market. And really, I think ag was responsible for the biggest part of this push in the Goldman Sachs index since August. And you can see what corn and soybean sales have done. It's been a record year, the 2021 marketing year so far. We've seen record commitments of sales, both of those crops. So that's really been the driver in the ag markets, has been soybeans and corn here this year. And you have to give credit to the funds. And I know a lot of us cuss the hedge funds or managed funds, whatever you want to call these people, when they sell the market. And we're seeing that today, by the way. I wasn't going to get into today's market so much, but over the last 5-6 months, they've been very active buyers. And the black line on this chart, and by the way, this shows what they've done over the last 11 years, and it's all over the board. But the black line is 2020. And if you go back to last spring, from April through summer, you can see that they basically went from zero net position to short 400,000 contracts at the height of the COVID outbreak. After that, and starting in about the middle of August, they went from short 200,000 net position. Now this, by the way, this chart shows corn, soybeans, soybean products, and all 3 wheat contracts. So just the grains. But they went from short 200,000 contracts to long 800,000 by the end of the year. About 1 million contracts combined of corn, soybeans, and wheat. So it was an incredible amount of buying that these people did. And again, I think we have to give some credit where credit is due, and the speculative fund buying is what rallied the market. Now, I think this is also representative of our biggest risk that we've got as we move forward, and we'll talk about that when we look at the crops. So I want to start out with soybeans, which again have kind of been the leader in this big rally that we had going back to August. But you can see export sales have just been at an incredible pace, record pace starting the year. This has all been China. China's been the big buyer of soybeans. They've really ramped up their purchases following the swine fever outbreak a couple of years back, when they really stepped aside in the market, didn't need to buy as many beans. We saw stocks build up in the United States at that time. But since then, they've been very aggressive, and to the point of almost reaching their USDA target now, with over half the year remaining. So in yesterday's report that came out, USDA did raise its export estimate by 20 million bushels to a record 2.25 billion bushels of beans. They did lower the ending stock number 20 million bushels down to 120 million. That would be the tightest bean stocks since 2014. And actually, our stocks to usage ratio is the same as it was back in 2014. Couple of things to point out on this balance sheet. Last month, USDA did raise its import number by 20 million, up to 35 million bushels. And I think what's happening this year, and it's going to happen as we go through the next month or so, with the lateness of the Brazilian harvest, you're seeing extra demand come back to the United States. China needs beans, and they need them now. They got boats to load, and they need to load them now. And Brazil's late getting the crop out, partly because they were late planting it, and partly because it's been awfully wet down there. So the combination of factors has brought extra demand back to the United States. We're using up all of our extra beans. We're getting rid of, either crushing them domestically or shipping them overseas. And you can see this 120 number, if you divide that into the domestic crush, that's only about 20 days worth of crush. At the end of August, USDA is saying we're going to be down to 20 days worth of inventory, which is probably beyond tight. I don't know where those 20 days are going to be at. And so we anticipate imports are probably going to pick up a little bit. I would think that's going to be pretty common. In the North Carolina coast, out of Brazil, you're likely to see some boats unloaded for the crushers and the hog producers and the chicken producers down there to be able to get bean meal. I heard a rumor yesterday of a company looking at bringing barges of beans up the Mississippi River this summer. So it's going to be a really unusual year based on how tight this balance sheet sits today. And looking at the world numbers, it's pretty interesting as well. If you go back to 2018, and I mentioned this a minute ago, that was at the height of the swine fever outbreak in China, and they killed off over a third of their hog herd before they got things under control. And the impact of that extended back to the United States and at the world level, that world supplies of soybeans reached a record level because China wasn't using them. But you can also see what they've done just in 2 years, how they've really snapped this thing back. That demand has been very strong and supplies have worked down rather quickly. So it's been a really unusual situation. We mentioned Brazil. They were late planting the crop this year because of drought. At least 2 weeks late through the northern and central parts of Brazil because of dry weather, and they were waiting on rain. Now they're late getting the crop out, partly because it was planted late, and partly because they've been very wet lately. And as of this last Monday, only 11%, now this is in the state of Mato Grosso, but only 11% of the beans have been harvested. That compares to 32.5% on average and 44.5% a year ago. So you can see why, if China had empty boats heading back across the ocean, they were probably going to be diverting some of those boats to the U.S. to try to get loads rather than sitting idle waiting to load in Brazil. And speaking of Brazil, the forecast doesn't look really good right now. As you get up into the northern central areas, Mato Grosso, Paraná, they're expected to stay fairly wet over the next 10 days. And so unless they, producers hit some windows in between rains, it looks like it's going to be difficult for them to get much of a start on harvest. The flip side of that is down in Argentina, where they've been very dry so far this year. And the Argentine crop has slipped a little bit over the last 30 days. And over the next 10 days, it looks like they're going to remain pretty much without precipitation. The only place that's probably going to see some help is going to be up here in southern Brazil, where the crop is still trying to get to maturity. And those rains should help that crop end up doing fairly well. Coming back to our markets, going back to the funds we talked about earlier, these managed funds as of a week ago are long still 157,000 contracts of soybeans. That is down from the record long that they had this past fall, but it's still a significant amount. And so to me, this is the biggest risk that we've got in soybean futures, probably over the next 2 months, is what happens if these funds decide to sell. It was happening today. At one time, I think we took beans down 48 cents today before things have kind of bounced back a little bit. So that's the risk that we've got. And you can see in other years like 2016, 17, the orange line here, that at this time of the year, they were long about the same amount of beans, but ended up being big sellers over the next few months and actually short by May. I don't think that's likely to happen this year because I think we have to make sure that the bean acres get planted. But nonetheless, that is the risk that we've got. So looking at the price chart for soybeans right now, I have to go to the monthly chart to show the last time we were at these levels, but that was back in 2014. And, if you're a bull, you would point to 2014 and say, well, our stocks to usage ratio is similar to that year. Maybe prices ought to be at that level as well. You could make that argument, and I wouldn't tell you you're wrong. Maybe we do eventually make a run up to $15. But here recently, over the last few months, we have made some strides. We broke through the 100-month moving average line, this purple line. That was a big hurdle. We took out the 2016 high at $12. That was a big hurdle. And then we shot up another $2 plus before we really just ran out of gas. And the market settled back down 3 weeks ago. Since then, it's kind of been a back and forth trade. So if I have old crop soybeans from a marketing perspective, I really like the minimum price contracts this year. Sell your beans, go buy a call option. And I would look at maybe a $15 May or July call. I could sell my beans today. If I bought that call for say 30, 40 cents, I could still have a floor price in the 13.30 future area and still have potential upside on into the late spring or early part of the summer. So I think that's probably the best way to attack this old crop bean market if you're still fortunate enough to have any soybeans left. Going ahead, the big question this spring is going to be acres. What happens to acres? And we're fortunate that we do have a plentiful amount of prevented plant acres expected to come back into production. But we've come off of a 2-year record amount. 2 years ago, we had nearly 20 million acres of prevented plant. This past year, we still had 10 million acres. I would imagine this spring, most of those 10 million acres are going to get into production because prices are up and because, quite frankly, much of the country's pretty dry. And a lot of people have been comparing this this year to the winter of 2012. That year we only had 1.2 million prevented plants. So most of us are expecting at least 7, 8, 9 million more acres getting planted this year. So what are they going to get planted to? I ran some different scenarios on the balance sheet here for beans. And what I really want to show is we need bean acres. That's the bottom line. Farm Futures Magazine came out with their survey of acres last week, and they were estimating 84.5 million acres this year, only up 1.4 million. If you have a trend line yield nationally with good demand, we would run out of beans. I'm showing a negative 90 million bushels at the end of next year. So we cannot get by with just 1.4 million more acres. So what if we raise 5 million more acres? What if we get up to 88 million acres? Whoops, I'm sorry. If that happens, then you could build stocks a little bit, but you're basically still almost at the same level we are right now. So that's, 5 million is really not even enough to make a true dent in this thing. I said maybe we got to get up to 91 million acres. And even with 91 million acres and good demand, we still would not build stocks back up over 300 million bushels. And 300 million to me is kind of the line where if you get below it, it starts getting interesting. So I think the market has a whale of a job over the next really month or so, and that's to try to shift acres into soybeans. And we hear around the country that there's a lot of people that did field work this fall with the intent of planting corn this year. So I think that we've got this market has a huge task at hand, and that's to shift acres to beans. So the way to do that is either November beans go up, corn goes down, or some combination of the two. And that's not necessarily the case today. We saw November beans when I updated the chart a little while ago, they were down 22 plus cents. In the big picture, things are still holding together. We're still above the 9-day moving average and the 20-day moving average, the red and the blue lines. And more importantly, probably the 50-day moving average is gold line, which is 1116. So as long as we hold above that, this market still is trending higher. That to me is the line in the sand. If you break below the 50-day moving average, then things can go south. I still like minimum price sales. If a producer wants to sell beans ahead of time, I'm probably a little less likely to sell beans than corn right now, but if I want to forward sell beans, I'm probably going to buy a call. And maybe I go buy a $13 call option. I could still put a floor in at $11 and maybe 30 cents with still upside potential for my call option. So I like that strategy. RSI down at the bottom of the page, the green line, it's at 56. Stochastics kind of turned over today, pretty much neutral type market as we sit here right now. I got a bunch of these orange lines on the page, and the orange lines represent crop insurance. And I'm a marketing guy, so that's the direction I come at things from. But I look at some of these tools that we've got available now in crop insurance, kind of like put options, where we can protect the downside on price. So if we end up starting, let's say at 11.65 a bushel for our base price and insurance, that's where we're at after 7 days. And let's say I buy a 75% revenue policy on my farm. And if I assume going into the year that we're going to raise an average crop at my APH, then it would take a 25% drop in price to start to trigger a payment. And in this case, that line would be just about $9 a bushel. So I would look at a 75% RP policy as technically right now a put option at $9. If I bump that coverage up to 80%, now I've raised my price loss line. I can go to the 20% drop, which is about $9.50 a bushel. A few years ago, we came out with a product called Supplemental Coverage Option, SCO. And SCO allowed you to add county-based coverage on top of an individual policy. So, and that county coverage would start at 86%. So if I were buying, let's say an 80% RP policy on my farm, I could add another 6 points of county level coverage, which would then take my price trigger up to about $10. Now we have a new product this year called ECO, which is an enhanced coverage option, which extends that coverage. I can now get up to 90 or even 95% coverage based on the county. So if I were to go to the 90% level, now my price trigger is up to $10.50, and at 95%, now I'm up over $11. So I'm really intrigued by these higher coverages this year. I could go to the Chicago Board of Trade and buy put options if I wanted. Those are not subsidized, so you pay full price. And by the way, you got to pay the premium the day you buy them. These crop insurance policies are subsidized, the ECO at 44%, and you don't have to pay the premium until fall. And ECO and SCO both give you bushel protection in case there's a county bushel loss. And they also have the harvest price option included. So if we have another bad drought year and the price goes up in the fall, then you get to recalculate your insurance guarantee based on that. So in addition to maybe using minimum price sales, I also like to use these higher insurance coverages as to really act as a put option here for this year. The corn market really dominated lately by export sales. And 2 weeks ago, we saw an incredible run of export sales to China. China nearly bought 5 million tons themselves. And you saw the impact in last week's weekly export sales report that really shot this number higher. So we're way above any year historically at this point in time. And USDA in its report yesterday, they did go ahead and bump exports by 50 million bushels. They did lower ending stocks 50 million bushels down to just about 1.5 billion. Now, the reaction of the market was actually bearish to this because the trade expected a bigger increase in exports and a bigger drop in ending stocks. So we'll see if that happens eventually, maybe in March or April. But for now, the reaction was a little bit bearish. I would tell you this number starts to be a tight number, but it's not as tight as soybeans, relatively speaking. The biggest situation in corn is kind of like beans. It's the funds. You know, these funds are long, over 360,000 contracts of corn right now. And so to me, that's the biggest risk that producers have until we go to the field this spring, is what happens if these funds decide to sell. And we're seeing some of that this morning with the corn market trading down in the teens at one point today. So, you know, ways to manage that risk. You know, if you look at the long-term chart, corn's probably gotten higher than what I thought it would. Again, give credit to the funds for getting it there, but we did take out the 2014 highs a couple of weeks ago, and even today after the sell-off, we're still at really high levels, all things considered. So I like the minimum price sales. If I have old crop corn to sell, I would sell and go buy a $6 May or $6 July call, just in case the market goes up. If it goes down, then I'll be glad I got something locked in. But looking ahead, the one thing I would point out here on the balance sheet is that it's going to be a lot easier for corn to rebuild stocks than it is for soybeans. And scenario one, I included 92 million acres of corn this year, which is up only 1.2 million. That could give us, you know, if we have a good yield, it could give us a 15 billion bushel corn crop. I think demand's going to stay good, but even so, we would have stocks building up close to 2 billion bushels. So it doesn't take a whole lot on the acreage side. It really just takes a good yield to rebuild corn stocks. What if we get to 93 million acres? You know, now you're starting to look at stocks potentially well over 2 billion bushels. Farm Futures Magazine survey had them up to 94 plus million acres this year. And with a good yield, now you're looking at the potential for stocks to push up close to 2.5 billion bushels. And I don't think we hold a $4 average corn price if that happens. I think you trade futures down below $4 in that instance. So to me, again, we've got some potential risk in the year ahead in corn. So similar to soybeans, you know, this market had rallied. Now it's kind of flattened out. The 50-day moving average, this gold line, was good support on the setback a couple of weeks ago. So at 432, 433, I think that's a line to keep watching. Keep that in mind as we go forward. I like the minimum price sales. And one thing I was looking at yesterday was selling Dees corn and buying a $6 December call. Those were trading at 11 cents yesterday. So at that time, we had 455 corn. That's not there right now, but you could have sold or hedged corn at 455 futures minus 11 cents for the call. You'd have had a 444 futures floor with potential upside if corn blew off the top end. 11 cents is not a lot of money to spend just in case, you know, you get another 2012 type market and the market rallies sharply. So that's the way I like to attack this corn market. The other thing I like is the crop insurance program this year. Because of adding ECO, now I've got the ability to get coverages up to 90 or even 95%. And if we, again, assume an average yield in the county, you know, then 90% trigger gets us over 405 and a 95 trigger gets you up over 4.25. And so now I'm really talking about adding some really good price protection within a crop insurance policy. And if I was down at the 80 or 75% level, I couldn't do that. So I'm really intrigued by these added products this year and what they can help do for me in the form of a put option. Finally, wheat. You know, wheat probably is following the corn market right now. That's about the best analogy I can give. When you look at the world numbers, even though U.S. stocks have continued to drop over the last 2 to 3 years, that's mostly been because of acres. World stock numbers continue to rally. So, the U.S. situation is only going to take us so far, but ultimately we're going to have to export wheat. Now, the balance sheet, USDA made no changes yesterday. The only change they actually made was at the average farm price. They did bump it 15 cents up to $5 a bushel. But going forward, the funds, long 21,000 contracts of wheat. You can see over the last 5 or 6 years, they've actually spent the majority of their time on the short side of the wheat market. But with the tightening U.S. stock situation, and with corn and beans rallying, that's kind of brought some of this money back into the wheat market as well. And over the last 4 or 5 years, wheat has generally been in a little bit of an uptrend. And I think you give credit to that for the drop in U.S. acres over that period of time. That has at least kept our stocks from rising and has started to actually eat away at some of the stocks. Looking ahead, this is kind of my guess for this coming year. If planted acres are up slightly, now that's not going to be because of spring wheat acres. That's going to be because of winter wheat and specifically soft red winter wheat acres being up this year. But if total wheat acres are at 45 million and we have a decent yield, production is going to come in likely slightly above last year. I think demand is going to stay steady, but ending stocks might drop 100 million bushels this year. And so, that has as much to do with, the drop that we've seen over the last few years in U.S. acres as anything. And if stocks drop back a little bit, I could see prices kind of working up a little bit. And it's probably going to depend on corn price and where it tends to go here over the year ahead. So if I look at July wheat, we had our base price set back in the fall period in the 550s. Now here we are trading up into the mid 6s. I don't think it's a bad place to forward sell some wheat if you got a good looking stand this winter, if you've seen it or not. But for the folks in soft wheat country, I don't think it's a bad place to be locking some in. Maybe you use a minimum price, but I think on wheat I would just be selling a little bit along the way at these price levels. Weather, I've only got 3 slides, and you can make out of them what you will, but the latest drought monitor that came out last Thursday shows still over 60% of the United States in some form of drought. The latest forecast as we work through April doesn't show a lot of improvements. Now, we do have a few spots in the Northeast, in the middle of the country that are going to improve. Those are the green areas, but the brown is expected to remain and the yellow is expected to develop. And so we're coming into the spring this year with much of the country looking at abnormally dry conditions. And the latest NOAA forecast that came out last week shows June, July, August, much of the country looking at below normal precipitation. The Northeast, probably the one area where we're seeing some spots of maybe above normal precipitation, but it looks like it has the potential to be another La Nina drought-driven type of a year. So that's part of the reason that I like marketing with options. If I want to make some sales to lock in prices, great. But buy the calls if I can get them bought fairly cheap out of the money, just in case we see some sort of a blow off market. And it's also the reason I like these added coverages as well this year, especially if I happen to be in an area that's susceptible to drought. Then you got the added, it doesn't take much of a drop in bushels to trigger a payment. And the other way around is it doesn't take much of a drop in price either. And you have the harvest price option available with those policies as well. So I want to take a minute, talk a little bit more about the ECO program. I've introduced this with the price charts, but ECO is enhanced coverage option. And I am proud to say that NAU Country was one of the leaders in getting this implemented for the 2021 marketing year. NAU, along with Watson Associates, took the idea to the RMA that we needed more dollars of coverage to be able to cover cost of production. Now, keep in mind that this happened before the rally in the markets. This happened back in 2019 when prices were cheap and producers were not able to get enough coverage to cover expenses. Now, with these added policies, not only can we do that, but we can actually lock in some pretty good profitability, I think, this year. And that's what's got me really intrigued. A year ago when prices were down, I don't know that I would have been as apt to want to buy this and spend the extra money. But this year that prices are up, now we've got a lot to potentially lose. And so we've got some great opportunities this year. So what are these coverages? Well, SCO, I did mention, it starts at your individual level of RP coverage and then goes up to 86%. It is a county-based coverage. ECO is also area-based and then takes over where SCO left off, starts at 86, goes to 90, or 86 to 95. It is an endorsement that's going to match your individual coverage. So if you have a yield policy on the farm, then SCO and ECO are going to be yield-based. If you have a revenue policy on the farm, then these are going to be revenue-based coverages. And by the way, we have it available for 31 crops here this year. So here's a picture of how it works. You're basically stacking coverages. And if you start out, let's say, with a 75% multi-peril policy on my farm, the next level, I could add the SCO protection from that level up to 86%. Then I can add ECO from 86 to 90 or 86 to 95%. So what I'm doing is really trying to shrink my deductible as much as I possibly can. And I kind of compare it to auto coverage. You know, I could go into this year with $1,000 deductible on my car, or I could drop it to 500, or I could drop it to 250. And this year we happen to be driving a really nice car with prices up where they're at. So that's what's got me intrigued by these higher coverages. So go back to the chart I showed you a minute ago on corn. You know, if I'm looking at SCO or ECO, I'm really looking at raising this price loss line as high as I can possibly get it this year. On corn historicals, if you look at the last 15 years from February to fall, 9 out of 15 years, we've had at least a 5% drop in price. So the seasonal tendency for corn price to drop from now to fall is really good, which means A, maybe I ought to be selling, but B, it means that this policy probably works more often than not. So if you have an average yield, the drop in the price would start to trigger a payment. Soybeans, again, look at where prices are starting at. We're at 11.65 right now on our base price. It doesn't take a huge drop for some of these coverages to start triggering a loss. Now, historically, we don't tend to see the same change in price from spring to fall that we do with corn. And probably part of that has to do with the South American crop now being such a big part of the world production. But I would point out only 5 out of 15 years have we had at least a 5% drop, but those 5 years we started out with pretty high prices. And so this is another one of those years we're starting out, you know, it looks like 11.65 or so. Maybe this is one of those years where SCO and ECO might make some sense to consider. A few other details about the policies. You do have to have an individual policy in order to purchase it. You may buy the SCO, but you don't have to. You could just buy your multi-peril policy on your farm and then skip SCO and go buy ECO if you just want to get that high trigger as high as you can. The ECO is not impacted by the PLC and ARC decision. SCO is. I will talk about that here after a bit. This is wrong on here. ECO is subsidized at 44%. SCO is actually at 65%. So the government's picking up a huge chunk of the cost of this policy. A few other details. The higher your APH is relative to the area, the more dollars you get paid if there's a loss in revenue. So this does reward producers that have higher APHs. Your indemnities, these county policies do not connect necessarily with your individual indemnities. So you could have a loss on the farm, maybe not in the county, or vice versa. So the policies are independent. The last 2 points on here kind of go together. And a year ago, the RMA started actually using real crop insurance data to determine county yields. If you remember a few years back, we used to always use NAS data. And a lot of us didn't necessarily trust the NAS data because we didn't know where the numbers were coming from. So RMA agreed that it would begin to use actual crop insurance data. So the yields that you turn into your agent are the ones that the RMA now uses to calculate the county yields. So that's a good thing. They're going to be a lot more accurate going forward. The only negative is that the production reporting deadline isn't until the end of April. So it'll take time to calculate county yields after that. So any payments for SCO and ECO programs don't get made until the early part of summer. To me, that's the only negative about these programs. They're going to be more accurate than they were in the past, but it's going to take a little while to get our money. So I did want to show you this indemnity worksheet that we put together. And this is really just to walk through how this program works. So let me show you an example of how corn would work on ECO and SCO. The yellow numbers or the yellow boxes on this worksheet are the only ones that have to be plugged in. So I'm going to start on the top left-hand side, and let's say we start the year with a base price at $4.50. Let's say that the harvest price drops to $3.90. My APH on my farm is 185 bushel an acre. My expected crop value is the higher of the prices times my APH, which would be $833 an acre. I'm going to say for this example, I buy an 80% RP policy on my farm and then add county coverage with SCO and ECO up to 90%. So I'm adding a 10% band of county coverage. I take that 10% times my expected crop value, my amount of coverage comes to $83 an acre. So that's what's represented by this 10% band. If we lose the whole 10% band, I get $83.25. The expected county yield in the county that I'm using here is 179.4. Take that times the base price. The expected county revenue is 807. The final county yield, I'm going to assume for this demonstration that the yield is unchanged. Price goes to $390 in the fall. The final county revenue is $700. If I divide 700 into 807, then I come up with 86.7% of expected revenue was realized. So in other words, the county lost 13.3% of its expected revenue. But this realized revenue is below my trigger at 90%. So I'm going to have a loss that I'm going to get paid on. That loss was 3.3%. Take that, divide it by our band of 10%. I'm going to get paid on 33% of that band of coverage, which, take that times $83, was $27.47 an acre. So that's how the policy works. And this is kind of shows why I like this policy this year. Again, because if we have an average yield, price goes down, we could end up getting some payments back. And especially if you go to the 95% level, then that really jumps. And so I would not rule this out. I would really want to consider it in your area. We also have this indemnity matrix. So the example I just showed you a minute ago was one example. The matrix has over 100 examples on here that it's going to calculate combinations of yields and price. And so you can see, if price goes down, in some of these cases, we're maxing out our dollars of coverage. But also want to show that in a yield loss and a price increase scenario, that your coverage goes up when the price goes up. So in this example here, if I were to lose 80% of the county bushels, and the price goes to 608, now I'm getting paid $168 an acre. So it does have that harvest price option included, which helps you in a drought type year. We also, inside our quoter, have the ability to show you what the history would have been, what would have paid if we'd have had ECO and SCO over the last few years. And this goes back to 2008, and this particular county shows a number of years that it would have paid. We can also overlap your yields with the county history. If you're thinking that maybe my yields don't match up well with the county, we can plug those in and show you how that would have been over time. Help maybe make it seem like this policy is going to be, would work for you. The last thing I want to talk about before I wrap up is the farm program. This is a letter that I had put out back in January with some thoughts on the program. Really, that hasn't changed a whole lot. The one thing I would state right now is because prices have continued to go up, it makes these programs look less and less likely to trigger payments for at least crops like corn and soybeans. And even wheat has dropped a little bit. So it's making the decision a little bit less important. But the one thing I do want to point out, because prices have gone up, it makes it really imperative to me that you talk to your crop insurance agent first before you go to the FSA office. And the reason is because of the SCO versus ARC decision. Let me show you what I'm talking about. Kind of a quick overview of the program. PLC, price loss coverage. If you're not familiar with it, it's if the market year average ends up below these blue numbers, then you get paid the difference times your payment yield at FSA times 85% of base acres. Keep in mind that both PLC and ARC pay on base acres, 85% of those, not on what you plant. The current year that we're in right now, we're about halfway through it. These numbers in this first gold box are the current estimates from USDA as of yesterday's report. Corn, soybeans, sorghum are way above their reference prices for PLC. Those crops won't pay anything this year. Wheat right now would be paying 50 cents a bushel if the marketing year ended right now. So the ones I've highlighted in gold would be low enough to trigger PLC payments. For the 21-22 year, the year you're deciding on right now, that year does not start until September 1st, and it goes all the way through August of 22. So we're still 6 months away from the beginning of that marketing year. This is the decision you're making here by March 15th. But this middle gold box, these are some numbers that USDA had projected back in November on price. These were their baseline numbers. They're really not based on anything other than what what economics looked like to them at that time. But at that time, they were projecting corn could go down to 365 next year. I wouldn't rule that out. If we do plant 4 or 5 million more corn acres, if stocks go up to 2.5 billion, it's possible that we could go back down below this PLC reference price. So I maybe flip a coin on corn. I would think that there's at least a chance that PLC could pay for the 21 marketing year. For soybeans, I don't see any chance that we're going to get below 840. So I don't think PLC makes sense to me. I would probably lean towards ARC given those choices. And then the other crops below probably all lean towards PLC. All of those crops prices have a good chance to probably be below that reference price. The ARC program, then, if I'm leaning towards it for beans, the only reason I'm thinking that is because if I were to have a regional drought, then maybe the rest of the country does well, prices don't go up, there is a chance that we could end up getting an ARC payment that way. So maybe beans and corn possibly could, but we're starting out with relatively low numbers on price that are not attractive either. Now, the one exception is SCO, because ARC and SCO are both 86% county-based programs. The government only lets you do one or the other. The two big things about SCO, if I decide to buy SCO, number one, on beans, SCO right now we're starting with a base price around $11.65 compared to $8.95. Corn's at $4.50 plus compared to $3.70. So SCO price is much better than what we're looking at here from the ARC program. And SCO pays on planted acres this year. ARC only pays on 85% of my base acres. So I think the first decision we have to make is whether or not I want to buy the SCO. If I do, then I have to elect PLC at the FSA office. If I'm not going to buy SCO, then I'm probably leaning towards ARC on corn and beans, just in case there's some regional drought. But for the other markets, the other crops, probably leaning towards PLC. So I hope that helped. So kind of wrapping up, got some big dates coming up. We're in the pricing period right now through the end of February. March 9th is our next WASDA report from USDA. March 10th, the day following each month's USDA report, I host what's called the NAU Country Aftermath webinar. Talk about the previous day's report, the impact in the markets, crop insurance, government programs. That all takes place on the 10th. 15th is our sales closing deadline for insurance, as well as the deadline at the FSA office. March 31 is a huge report day. That's USDA's planning or prospective plannings report with their first official estimates of acres based on their surveys. So I would venture to guess it'll be a market mover when we get that report on the 31st. So one last thing I do want to mention is our things that we provide at NAU Country. I do an opening bell phone call. Comes out right after the opening each morning at 9:35 is when I record it. It's a 2-minute phone blast, tells you what the markets did and why. We send an email letter every night called the market report with the updates on the markets, crop insurance prices, etc. If you're interested in either or both of those, let your agent know and we can get you hooked up. I mentioned the Aftermath webinar. I also do a podcast occasionally as well. So a lot of different ways that we try to get information in front of our insureds, not just helping you with crop insurance, but we also want to help you do something with the policy you're buying. So with that, I'll wrap up and turn control back over. I appreciate the opportunity to visit with everyone today.
Great, thank you very much. Without further ado, I guess we'll go right to Zach Harding's presentation. I gave you his bio at the beginning of the webinar, so I won't revisit that. But Zach will bring a important, more Northeast perspective to things. And we can see your slides, Zach, and I guess we'll just leave it to you.
Okay, very good. Can everyone hear me?
Yeah, we hear you just fine.
Awesome. Well, thank you so much for having me on here, Rich. That was a great job. Thank you for your presentation. And thank you to Jeremy and his team there at the Crop Growers for inviting me on. This has been something we've been doing with the group for, I want to say, over 10 years. And it's been, I think, successful for both of our businesses and our producers as well. So Appreciate being invited here today. My name is Zach Harding. I've been a merchant at the Andersons, or formerly Lansing Trade Group, for over 10 years. I spent almost all my career in the Northeast trading corn, soybeans, and wheat, and some feed ingredients for our group there. We have a merchandising office in Auburn, New York, with 4 traders and a couple staff. And then I work out of our Overland Park headquarters here. I've been back here for about a year. I really want to focus today on tying Rich's presentation into what we can do locally. I want to talk a little bit about what we're seeing in the markets as far as supply and demand. Obviously, not going to hit on the bigger things. Rich hit those very well, but some of the local things, and then talk about some options for contracting and working through the volatility for this year and for next year. There we go. Start off with some marketing goals, supply and demand. I'll talk a little bit about the advantages of a grain merchant and a relationship with one. Again, contract strategies, and then how we're going to put those strategies into action. I think to start off, the marketing goals we really want to address today on a local level is finishing out our old crop sales and starting to get really serious about new crop. We think the country is around 65 to 75% sold on old crop corn, and about 85 to 95% sold on old crop beans. On new crop, we think the country is around 20 to 25% sold on corn, and probably 10 to 15% sold on beans. So obviously much farther along on old crop corn, which is where we like to be, but we really need to get started on new crop. Rich identified in his presentation using the crop insurance programs that you guys implement to encourage those forward sales. And then, as Rich also mentioned, identifying some tools that we can use to cater to your business that allow us to be in the market longer and capture additional upside. So we want to avoid cancel if close orders. In markets like this where we see very big rallies, we'll talk to a lot of producers and they're looking for $4.50 cash or $5 cash, and when it gets to $4.90, they say cancel my order, it's going to go higher. And we want to be really intentional about the targets that we're setting and be firm on those targets, avoiding that capture or avoid the cancel it close and losing 50 cents trying to capture another 10 cents in upside. Overall, the overarching goal I want to get across today, as Rich said, is setting floors and figuring out which tools we can use to capture and participate in the market to the upside. Just some pretty simple supply factors. I just looked at corn and beans for the purpose of this presentation. We can see Pennsylvania obviously had a little tail off last year. It was a tough growing season for them, both in corn and beans, a little less in beans. But I think overall the main takeaway here is the linear trends, both combined on corn and soybeans. More pronounced in beans, but still there in corn. So we expect this trend to continue over the next few years with, in general, increased production. Now, obviously, tillable acres, there's only so many, but we do believe in precision ag and the ability of the farmer to continue to push the envelope in yields. And as Rich kind of mentioned in some of his numbers as far as carryouts are concerned, we really think a good yield can bolster production for the next few years. So something to think about on the supply side. Just a few factors on the demand side. I think New York and a lot of the Northeast was hit pretty hard by the Fulton ethanol plant closing down. They use between 10 and 15 million bushels per year. That plant changed hands in 2019, stopped producing in the spring of last year, and has not operated since. We are in contact with the new company, and they're hoping to restart the plant this year, but just what we've seen last year and the environment and ethanol margins right now is still relatively difficult. So we believe that we have to plan our marketing plans around not having the ethanol plant again this year. If it comes back, fantastic, but we want to be realistic. Livestock industry margins, obviously with the increase in commodity prices, food prices start to get stressed. So we're not seeing a lot yet across most of the livestock sectors we're seeing, but obviously with COVID and some of the demand loss destruction that we saw, it is a concern for a continual run in higher prices. Another thing we're starting to see a lot of is the emerging non-GMO and organic programs. So from the demand side, we're taking away or losing some conventional milling demand that is going to or transitioning to non-GMO and organics. Also on diversification of crops, this could be a supply factor, but I believe it's really being led, and again, kind of back to the non-GMO and organic programs, it's being led by emerging markets with relatively large premiums. There's not a lot of product in the market, and they seem to be premium products that allows growers to diversify. And then in the pet food space, so the Northeast is a relatively large pet food market, and we did see over the past few years a big push into grain-free diets. So they're using different types of vegetables, pulses, other types of ingredients as opposed to grain. So that's a demand factor that we're kind of watching closely. There has been some issues with the grain-free, so we're kind of keeping an eye on that. But again, another trend that is not particularly friendly to corn or wheat. So kind of switching gears here to the advantages of a grain merchant relationship. One of the main things, our job is to always have a market for your grain. So whether that be corn today, corn in June, corn next June, or corn 3 Junes from now, we should be able to provide you a price for that. A lot of times your end users aren't available to provide markets farther out the curve. Their customers aren't necessarily interested in buying. And so they don't have those market opportunities. A grain merchant should have opportunities and prices available for you. They might be good prices, they might be bad prices, but a price should be available for you at all times. Another thing, multiple destinations and outlets. One of the biggest advantages I think of grain merchant positions is their ability to be flexible with contracts and the different destinations or users or customers that they have to maneuver contracts around, to maneuver loads around, to keep everybody moving at harvest or during the year. I think that's very important. So another opportunity with a merchant that you wouldn't see with a single end destination user. Another thing is access to research, market analysis reports, and opinions. One of our jobs, and I get probably, Rich is the same way, I'm sure, 20, 30, 40 emails a day with different grain wires, market wires from all across the world, different commodities, different futures markets, all of those things. And our job is to read through them, digest them, then develop opinions about the market. And every merchant that I know is very, very happy to share his opinions. So use them as a resource to dig into the market. You don't necessarily have to agree to them. You don't have to sign a contract, but definitely talk to a merchant and pick their brain a little bit about what they're seeing in the market. And one of the last things about a grain merchant is the counterparty risk. So merchants assume counterparty risk with whoever the end user is. And that's a little bit different between a merchant and a broker. A broker will just bring you a buyer. He'll say feed mill A can pay you $4.50 a bushel, and here's your contract number with feed mill A. Your risk is with feed mill A. In a merchant situation, you may be delivering to feed mill A, but your counterparty risk, your contract risk is with the merchant. So a long-standing, strong relationship with the merchant can definitely take some risk off the table as far as credit risk. Okay, on to the contract strategies. Rich, thank you for doing my pitch for me. This is absolutely the best strategy today in today's market based on the volatility that we see and the potential upside coming this spring and this summer. So basically, as Rich alluded, you were going to cash price your bushels and you were going to buy a call option or a call option feature. As your futures rally, the value of the option rallies. And essentially, you have a floor set, but the upside, the value of that call could, and I like to use quotes, be unlimited. Now, it's obviously not unlimited. And one of the most important things about buying a call feature is understanding the time value and that 90% of call options expire worthless because no goal was set, no price was set to sell the call feature. So as the futures rally, it is still your decision as a producer to come in and say, sell my call option. And in a rallying market, that's just another decision that you have to make to capture additional upside. That's another farmer decision. So if you want to have the floor in place, but then have the optionality to pick up whatever upside might be there, that is totally your prerogative. But again, if you look at the history of options, a lot of them, the majority, expires worthless because of not understanding time value and the depreciation over time, and then eventually losing the value of the option, even in a market rally. So another option that we have, or we offer here at the Andersons, is a minimum price average contract. So very similar, that you set a floor. In this case, I used 430 as the floor, and it's over a set time frame. So call it anywhere from 100 to 300 days. Into harvest of this year, you set a floor price, and you're averaged on a daily basis at or above the floor. There is no maximum on this contract, so it will average every day above the floor at whatever price is settled on the board at that close. The advantage of this program is obviously that there is no ceiling. There is no total upside of this program. The downside of this program is because of quote unquote unlimited upside, your floor is slightly lower. So to allow you the opportunity for more upside, we have a slightly lower floor. The next option that I have is called a min-max. So it's essentially the same type of contract. It's an averaging contract where it prices a small piece every day along the pricing window. But what it does is it finances a higher minimum. So in this case, you have a $450 minimum because you put a maximum at $5. So we used a realistic ceiling at $5 to finance a higher floor at $450. This strategy has been in our group way more popular than just a minimum price or buying calls for two reasons. One, you get a better floor, and two, you are not getting a second decision to have to sell your call. This is a 100% pricing program where you are guaranteed a futures level in between $4.50 and $5. This is our most popular product for this year. This is another averaging product. The only thing about this one, it doesn't have a floor. And so one of the reasons I brought this up is another really popular program that we have is seasonal averaging. So typically 6 or 7 out of 10 years, your highest pricing periods are going to be April, May, June. And we have a seasonal period set up every year. What we can do additionally, and I talked about this at the beginning about catering to your operation, but you can set up your own custom seasonal averages. So say you want to average the corn price from today until March 31st. You can set up your own custom average for those periods. Again, you do it one time, you are guaranteed a price, you don't make another decision, and it averages every day from now until the date that you choose throughout that period. So undertaking action, I think the next steps, the most important steps are taking stock. So we need to figure out how much inventory we have left, what open contracts we have on, and where do we expect our new crop production to be for this upcoming year. I like what Rich does when he uses different scenarios for acreages and yields to come up with production estimates. So we make sure that we have a number of scenarios that all can apply to the same plan. The next step is call a grain merchant. Like I said, there's 4 in my office. They're all over the country. We all like to talk about the markets. We all like to talk about contracting options. Call a merchant, try to build a relationship, get to know them, and open up a door, a connection for further down the road. Once talking to that merchant, you should be able to develop a plan. We want to sell at least another 20% of our old crop by March 31st. We want to be sold out of old crop by June 1st. Things like that. Work through those with a grain merchandiser on a plan, and then you can put targets in place and contracts in place to execute. That is the most important thing, is pulling the trigger and getting contracts in place to execute. And then lastly, focusing on the next sale. Like I said, we want to avoid the cancel it close. We don't want to look in the rear view. We have to have, in this type of market, in a bullish, in a super volatile market, we have to have a forward-looking approach. If we spend all of our time looking in the rear view and the contract that we priced 20 cents ago, it's going to be a terrible year. We always want to focus on the next sale in front of us. So that is really all of the slides that I have as far as contracting options. I put on here the website for Anderson's products. You can go through all of those contracting options, and actually every other one we have a whole suite of options. Those ones that I mentioned are, I think, most applicable to the market today, and probably some of the best solutions, but there's definitely a lot on there, and you can read through them. Like I said, feel free to reach out to me at any time, and I'm happy to work through them or put you in touch with someone that can.
Thank you very much, Zach. So before we go into Q&A, I would like to first of all recognize our co-sponsors of this webinar. I neglected to do that at the beginning. AgChoice Farm Credit, as well as Yankee Farm Credit, along with Farm Credit East, are co-sponsoring this webinar for crop growers. A few questions came in. Here's one that I'll pitch to either Rich or Zach, and it's that I feel a bit overwhelmed by all this information. Where to begin other than just by calling my crop growers agent? Any advice?
My advice from a marketing perspective is get in touch with a grain merchandiser, and just talk over your situation and talk over some of the options that are available to you today. Like I said, we don't require a contract or anything like that. Just talk over some options.
Okay. Another question is, how do you feel that the markets and insurance options should perhaps direct selection of crops for 2021, for spring 2021? Do you think that should steer the farmer in one direction or another?
I'm not sure if I understand the question, but you know, I would imagine that a lot of people are looking at profitability, and besides crop rotations, of course. I mean, that usually seems to come up first for a lot of people, but I mean, you're looking at profitability, one crop versus the other, and you know, that's where I'm looking at, like, the bean corn ratio right now. You know, probably needs to push closer to 3 to 1 in order to attract more people to want to plant soybeans. And I think the numbers kind of point out that should happen, whether it does or not. You know, if it doesn't, then ultimately that would be a little friendly to bean prices down the road.
Okay, yeah, I think that's what the asker was getting at, is other than agronomic concerns, are there any crops that look particularly attractive, you know, from a market standpoint?
Just to touch on that real quick on just on some of the specialty crops that we're seeing pop up. Grain sorghum is one that's been used in dog food in the East for a long time in pet food rations. That's becoming very popular and trading at or above corn prices. Canola is another product that we're looking at. Canola was trading at or above soybean prices this year. Other small grains, oats, barley, critical, things like that, we've seen them a lot of years. The profitability on those varies year to year, but yeah, I think those first two, probably sorghum and canola, are two main ones that I think are actually getting evaluated a lot.
Okay, thanks. That was a very good information, Zach. So we're a little bit past 2 o'clock, and we just had those two questions. So I think it's time to move on for the sake of respecting everyone's time here. I would like to mention a couple of things. This webinar recording and materials will be archived at farmcrediteast.com/webinars. We will try to have it posted by this time tomorrow. If you check back, if you wanted to access the recording or see the slides. I would also like to emphasize our COVID-19 resource hub, farmcrediteast.com/resource hub, or if you just go to the main website, it's under our Knowledge Exchange tab. That contains all kinds of information on COVID-19 government relief programs, PPP, keeping, information on keeping workers and customers safe, all kinds of information like that. So, and we keep it up to date, updated fairly frequently. So I'd like to emphasize those two options for those who are in attendance. And otherwise, I'd like to thank you very much for your